So the markets continue to go through a quiet week this week. So with that said, as I mentioned in my previous video, today I wanted to do kind of a year in review, but mostly a what to expect in 2018. So it's kind of an outlook for the next calendar year. There's a lot of exciting things coming out from market scholars, and make sure you're following our new Twitter account at market_scholars. You'll see our icon or logo there. You also see, you can, on my Twitter handle, you can see a link to it as well as on Brandon's Twitter handle. So make sure you have great things coming out in 2018 there. But today's video will focus on what to expect from the markets in 2018 and how what kind of returns should we expect based on past precedent, and how to handle that. Where is money going to be moving? Where could it be moving? Where could it be flowing based on patterns we're already seeing? And how can we manage our portfolio accordingly, so that we don't miss out on any opportunity, but still are able to protect ourselves in case of worst case scenario that could happen at any day. So that's what we're going to dive into. A trade ideas always, but the bulk of the video today will be kind of a 2018 preview. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Thursday, December the 28th, 2017. Thank you very much for watching. And for those who found us for the first time, welcome. Keep coming back for more day after day. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're down there, hit that thumbs up icon. That lets me know that you like today's video, that you want me to do it again tomorrow, or in this case on Tuesday. Because remember, no video tomorrow. We'll take the New Year's Eve weekend off, and then we'll get back together when the market reopens on Tuesday. Scroll down further, comment on anything that stands out to you, and tell me what you think about 2018 and how you plan to prepare your portfolios. So make sure you comment on that below. In the video description, there's a bunch of links there for you. Subscribe to my daily email newsletter by clicking that first link that's at the top, again, in the description below. Also, make sure that you're following me on Twitter. You'll see my handle at the top of the screen here, at DavidSettle42. I produce more content throughout the day in addition to these videos, to try to link the videos to each other in between. That's the stuff I'm putting out there on Twitter. I also put that on Facebook, so make sure you follow me or join the Market Outlook community as well, for those of you who are on Twitter, or for those of you who are, make sure you do it too. The address to join the community is up there at the top. The Market Outlook Facebook community. You'll also see there's a link that you can click on in the description below that will take you straight there so that you can join. All right, well, let's take a look at the S&P 500 here with the market forecast indicator first off. You can see we came really close to a cluster on the S&P. Intermediate lines in the reversal zone, of course. The near-term momentum lines jumped up higher as we're kind of bouncing off this 38% Fibonacci level. And market sentiment's obviously still up in its upper reversal zone, up above 80 here. Something to take a look at. I kind of wanted to take a little bit longer perspective in today's video. If you take a look at the, let's go back even a little bit further. The market sentiment line down there. If you notice, there's something unique about the market sentiment this year compared to previous years. This year, you notice we never dropped below 50. There was a couple times where it dropped. It got down to about 60 here and 50. And you can see, you know, what it looks like, what those drops look like up here. It's not very much of anything. And the last time we dropped below 50 was at right before the election, the presidential election. And so, and before that, it was at the beginning of 2016, kind of end of 15, beginning of 16. And so you can see how those market sentiment pullbacks look like compared to the lack of one this year. You notice the last time we went a full calendar year without market sentiment dropping below 50 was 2013, 2014. Now there's something unique about this period, and that was we had QE3. QE3, remember, started at the end of 2012, so coming up off that low point, we had QE3 that went all the way to 2013, started to taper here at the beginning of 2014, and finished right there. So that was the end of QE3's tapering in 2014. We continued higher through 2015. Divergences forming up there. and then finally we had some weakness in end of 15, beginning of 16. So, but we had a couple of calendar years, one in particular, 14, where we never did drop below 50. If we go back, even in 2005, a lot of people are comparing, you'll see here in a minute, comparing this calendar year to 2005, when the market was also, really bullish. And you can, when volatility was really low, but you can see even then we had two dips below 50 on the market sentiment line. You can see the drawdowns that it formed there. And so that was another year where volatility was really light, but still had drawdowns. I mean, if you look every calendar year, we have a drawdown that brings market sentiment down, except in extenuating circumstances. The extenuating circumstances here was QE3. The extenuating circumstances here is the fiscal version of, the monetary accommodation that we got. So the market's viewing this tax reform, and for that matter, healthcare reform that didn't quite get through, but the expectations were there for a lot of the year. And then, of course, infrastructure reform, or infrastructure spending bill at the beginning of the year next year. It's anticipated that there would be one at the beginning of the year next year. All of that monetary accommodation is viewed from this technical perspective as just as bullish to the market as QE3 was. And you can see what QE3 did there. And you might say, well, QE3, and look how bullish the market was. And the market was very, very bullish during that time frame. But you can see it didn't tank from those extreme highs. We did have some pullbacks and nothing trend changing there in the end of 15 and 16. But then you can see what came out of that. So I don't expect us from now at the beginning of 2018 to have a sharp drawdown. I do expect that we will get the market sentiment line below 50 at some point in 2018. And I like 2016, where we had the one drawdown right there in 2006. That's probably what it's going to look like, is some kind of drawdown that will seem significant because we've gone so long without one, but in reality will not be very significant. In fact, if I were to draw now the last time we've had a market sentiment line low point between 20 and, the last significant low point we had there. So we'll try to draw as best as we can up into that area, and we'll customize that one and color it orange to match the market sentiment lows. Again, you can kind of see, here we rallied up, quick little Brexit drop that brought it down there for a little bit, but you can see how quickly that was bounced back up. Then the election drop that brought market sentiment down. We were already bearish heading into the election. We had a bearish trend going on there. So you can kind of see about a 23% Fibonacci retracement. For us to get, that kind of retracement right now, we're looking at, if we peak right now, which I don't think we have, but if we peak right now, then a 23% Fibonacci retracement similar to that one would get us down to that 50% retracement on the intermediate line, which we've talked about before, that 38 to 50% range for a pullback. So, so you can kind of see that's why if we get something like this in 2018, which is kind of what I'm expecting, this 2006 drawdown, then it will just lead. You can see what came out of that. It was a sharp move higher out of 2006. Remember, volatility again was very low, and we'll see that here in just a second. So that kind of gives us a little bit of a view, and that's something I tweeted out earlier. What do we expect? Well, in January, considering that we're 4 months along in this intermediate trend, and considering the seasonality of the last 20 years, January should be weak. It typically is. That doesn't guarantee anything, but considering the environment that we're in, don't be surprised if we don't see some weakness in January. But that doesn't mean, I don't think that will be the big drawdown that brings market sentiment lower. I think that will come later in the spring, according to normal seasonal trends. And then end of the year, as usual, pick up to where we have a positive year. And that's the expectation, barring any, news events or anything else like that. But just from a pure technical standpoint, that's how I view. We wrapped up 2017, and that's how I see us going in to 2018. Now, that's only a calendar year. That doesn't mean that my next 10-year projection is that high. I actually think the returns for the next 10 years will be really low on average. Say, so for example, if we're looking at 2 to 3% a year on average over the next, and that doesn't count inflation, over the next 10 years, that doesn't mean that we're going to have every single calendar year be a 2 to 3% return. So next year, I actually expect that we'll beat that. But that doesn't mean that I expect double digit. We've had double digit returns over the last 10 years to now. I don't expect that for the next 10 years from today. I actually expect a lot lower. I just don't. But to get those lower returns, typically it's because we have a down year. And I don't think 2018 will be that down year. I think we'll continue to move our way higher. But it won't be like 2017. There will be a more significant drawdown. It won't be major. It won't be a bear market, but it will be enough to bring that market sentiment line below 50 for the first time in more than a year. More than a year since we've had that. So this week is a really, really quiet week. And remember, again, we are high up above that 200-day moving average. The 50-day moving average is high above the 200 as well. We don't ever tank from these levels, so we're not expecting a bearish move anytime soon. In fact, if you notice here, I've compared us to the QE3 period, right? Well, QE3, the 50-day moving average bounced above the 200-day moving average at the end of 2011, so the golden cross. And then we had a couple of touches of the 200 as we were clearing that, right, just at the beginning for that full calendar year. Operation Twist, QE3 came in there, and then we bounced. Never sustained a move below. We just hit those 200-day, which happens when you get that golden cross. After the golden cross, you typically will get some tests of that 200-day moving average. And then we bounce. And then we've had 2013, 2014, all the way eventually to 2015, a bunch of arrows that suggested that we get a death cross, which is the 50 crossing back below the 200-day moving average. Not a death cross in terms of like, Lehman Brothers death, but just, death of the bullish trend that we had until we got a new one. So that was, 1, 2, 3, 3.5 years of that 50-day moving average being above the 200, fueled by 2 years worth of, almost 2 years worth of quantitative easing, of monetary accommodation. Well, again, we have the fiscal version of that now going on. That a lot of this was just anticipation for, that now we've actually got a bill passed, and there's still more anticipation heading into 2018 for more fiscal reform. Or fiscal accommodation coming, or fiscal, bills being passed by Congress to spending and in this case, infrastructure spending. So we are, if you notice, we got the golden cross at the beginning of 2016, so well before the election. We had a couple of tests of the 200-day moving average after the golden cross, similar to 2012. This was Brexit. This was the election. And then boom, right? And you notice neither one of those did we stay below it. We just bounced right off of that, which typically happens after a golden cross. And then then it's rallied for a full calendar year, again, similar to 2013. Are we headed for a more of a 2014? That's the kind of pattern I anticipate heading into 2018 with higher economic growth expectations, interest rate hikes. So again, if I were to go back to the last period where we had interest rate hikes right here in 2004 to 2006, that's the move right there from middle of 04 to middle of 06. That's the move we had with interest rate hikes. Coming out of that, you can see 2006. That's the period I was talking about before. Volatility was really low right here, right in the middle. So I'm anticipating, again, it won't be as pretty as 2017 was, but 2014, 2006, where we do get a test down to the 200-day moving average, bringing the market sentiment line down. That's what I'm expecting in 2018. From a 3 green arrow standpoint, again, we have been trading above the 8-day moving average now for quite a while. In fact, if I were to now change this MACD here really quick and change it from measuring the gap between the 8 and 17-day moving averages, and just look at the gap between the 1 and the 8 to see how long we've been above the 8-day moving average. So this black line you'll see crosses above zero when we get above the 8-day moving average, crosses below zero when we get below it. So we've had, October, we were above it for quite a while. You can see here, and from mid-November, we're briefly below it, right where my cursor is. We bounced off of it and have now stayed above it since. So we are a month and a half into the S&P 500 being above its 8-day moving average. I mean, we had a good run in July where we were close to a month above the moving average, and I mentioned that one there in October. From the middle of September to the middle of October, we were there, with a single day cross. You can see here, like in April, we were above the 8-day moving average for a while, and then in May, for about a month, we were above the moving average. Over here in February, we got above the 8-day moving average right there and stayed there until the beginning of March, where we started to test the 17. So all these periods, these pretty bullish periods, were a month long. We are now, like I said, a month and a half almost being above the 8-day moving average. So very extended rally. Again, another reason to expect volatility. Nothing, we don't drop below the 200-day moving average of the 50 when we're this far above the 30. So it's going to be a while before we really get, a pickup in volatility. But in January, like I mentioned before in the previous video, I expect that we'll probably get the intermediate line dropping below 50 in January. Not necessarily market sentiment, but at least the intermediate line will probably get an orange circle in January, and most likely be probably right around this area here where we'll find some Fibonacci support. I don't think we'll drop all the way down, but we'll probably just kind of start to grind away in this area while those long-term moving averages start to compress and that MACD starts to work its way down. And I mentioned before, the MACD, and this won't happen overnight. It'll probably be most of January. The MACD here is crossed below its moving average, and most likely will work its way down towards zero like it does here for most of the next month. We might have some upward moves where we get up to the moving average. Most likely work our way down, and you can see that divergence on the stochastics is also sitting right around that 23% Fibonacci level as well. So it's been interesting to see here. We've been gapping up higher the last couple of days this week. We gapped down on Tuesday after Christmas, but then finished up, gapped up, finished up, gapped up, finished up. So of course we came down, but we had that last 10-minute period where we bounced up, gapped up, came down throughout the day, bounced up again. So it's a common theme for this holiday. And again, look at the range that we're in. We're still easily trading within last week's range. So very, very quiet move. The 4-week range is going to be tightening up here. So now it's actually tightening up to that low point, that big low point right there. Give it a second to update this. So we'll move this up to here. And then you'll see here in just a few more days, we're going to move that up to this December 6th low point. And then after that, we'll start to gradually move it day after day. So most likely the week after, we'll start to move it up day by day until we get to there. And again, that's a tight range if we don't move this higher. We might move that up higher a little bit, like in the first few days of January, but not significantly higher. I don't think we're going to continue to push a 10-point range here and push that up while this is up. We are in the mode now where the 4-week range is tightening, and when it tightens, that's what typically leads to a break and more of an extended move to the downside. Not a bear market move, but forming an intermediate low point, an orange circle on the chart. Is going to have to break below that low point. But to break below that low point, you got to start trading in the lower half of the chart. And then you can see as of right now, we're not. So like I said, don't expect it, first few days in January, but it will be a month-long process where we'll start to, trade in the, in this area here, and then we'll move this up, and then now all of a sudden trading in this area will be the lower half of the chart, and will be that much more likely for a breakout to the downside. Don't read a lot of stock into the range of the trading. You can see the range was about half a point again after a 3/4 point yesterday, half a point on Tuesday. The volume's under 50 million. Of course, that's going to bring these numbers down. But that's not because the market's bouncing up and going to move up higher now. It just means that it's the holiday season. So these will start to pick back up again as we start to produce some volatility in January. If you take a look at the VIX, you can see the VIX here. It is slowly moving higher and trending higher. We did get a move up here this week to above 10.5. We are pulling back right now to about 10. It's going to be hard to form a lower low point than this. Then we were below 9 there for a brief period of time. So we are gonna, we are slowly moving higher in volatility, and when you were this low, there's more likely that we'll move up to the upside. Now, one thing I mentioned when I tweeted out this morning, if you take a look at the annual range, now that we're close to, get rid of these drawn items, now that we're close to the end of the year, the range right now for the yearly period, so I changed this to a yearly period, is 8.72 points, second number from the right up here. 8.72. The last time we had that range, that small of a range, was 2005. So again brings up that 2005 period, right? And then you can see what happened in 2006. The market was bullish. I think it rallied 13%. So the market stayed bullish, but the range picked up to almost 14.5 points. So almost doubling the range, but still a bullish year. So, again, 2013, you can see the range got down. The range picked up in 07 and 08. Not surprisingly, that was your big bear markets, right? 73-point range and volatility in 2008. Then 38 points, 33 points, another 33 points in 11. 2012, we have a 14.5 point, and then back down to 10.5 points. So you can see another similarity to 2013, a small range with QE, with accommodation, monetary here, fiscal here, and then 2014, the market rallied. You can see volatility rallied, but the market rallied too in 2014, and the range picked up from 10 to 20. So again, double. So 2006, 2014, coming off of small range years for volatility, but still those almost doubling the range and volatility didn't produce a bear market. It actually produced another year of gains. 2006, we had, let's go back to S&P SPX here, and we'll zoom in on it. There we go. So 2006, you can see here's 2005. So from the end of 05 to 06, see the number right here, percent change. It was 13.6% return in 2006. And then if I were to do the same thing in 2014, so here's 2013 right there, the close, and go up to 2014, you can see 11.3%. So both double-digit returns, even though volatility's range doubled in those years compared to really quiet years for volatility in 2013 and 2005. So again, very similar to 2017, the expectation 2018, still bull market, but more volatility, a bigger range, producing that pullback in market sentiment. And you can see on a relative basis, volatility is still extremely low, so still below 80%. So there's going to be more pressure on volatility to the upside right now than it is to the downside. And again, leading to potential weakness and a potential intermediate low point in January. Not necessarily a market sentiment drop to below 50, but at least, or even a test of the 200-day moving average anytime soon, but at least a new intermediate low point. So most likely some kind of test of the 50-day moving average, maybe even producing 3 red arrows on the 30-day moving average and MACD and stochastics. All right, now we transition to what's driving this price action today. It continues to be, you can see how treasuries were just beaten up. They're bouncing. They continue to bounce. Gold and crude oil continue to rally and are really strong performers along with emerging markets. So when you see these 3 things just really beating everybody else to a pulp, then what you, and small caps too outpacing, then what you say is, okay, it's a weak dollar move. And that's what we got. The dollar's dropping A weak dollar move would mean commodities and gold will rally, and emerging markets will bounce too. Now they dropped throughout the day, but they gapped up sharply and they finished the day strong and have had a nice move over the last couple of weeks. So when you look at the dollar here, you can see how we're dropping down over the last couple of months, hitting new low over the last couple of months, pushing that lower Bollinger Band down, dropping back into the below the middle exponential moving average, starting to trend a little bit lower again. If I were to take a look at a longer term view with the moving averages, the 50-day moving average is below the 200-day moving average, and we're trading back down, bouncing back below a downward sloping 50. So bearish trend for the U.S. dollar after its death cross back here in April. Bearish trend for that. So what does that mean? Well, you can see what the impact it has on crude oil. So it's going to have a bullish move. Now getting up to 60. There's going to be some resistance in this area around 60 from 2015. But breaking above that puts 80 into play. More stronger resistance around 80. And you can see gold prices taking its cue from a weak dollar move too. So after dropping a few weeks ago below the 200-day moving average sharply, in 2 weeks we recovered that loss, that 1 week's worth of loss, and then bouncing up to almost 1300. Again, back up above an upward sloping 50-day moving average. So we had our test below the 200 and failed it, and failed that breakout move. And now, okay, now we'll start the move. Now it's going to move higher again. Weakness in the dollar kind of driving that. So if you were to now zoom this out all the way to basically the last year to date, essentially, emerging markets and international stocks had a great year, banner year. Stock market was up too, so it wasn't like U.S. stocks struggled, but they underperformed almost double. The emerging markets almost doubled the return that the U.S. stock market got. Large caps you can see outpacing small caps, and you can see the dollar had a down year. But with that down year in the dollar, it didn't have an impact on crude oil prices. So crude oil prices just barely started to move higher from this June low point. From that June low point higher, you can see weakness in the dollar driving a lot of that gain, and there's emerging markets, and gold lagged behind. So dollar continued to trend lower in 2018, even with higher interest rates, even with stronger growing economy, at least you would expect compared to other developed countries. The weakness in the dollar with this technical trend will translate into continued outperformance in emerging markets. Now, just because we had a year's worth of outperformance in emerging markets doesn't mean that now we're done, right? Emerging markets has been lagging behind the S&P 500 for years, essentially since QE2 came out. Once we had QE2, emerging markets just struggled against the S&P 500, and we're talking like 1, 2, 3, 4, 5, 6 years worth of underperformance before finally bouncing, and that's this year. So don't expect that we just had, okay, we had a good year in emerging markets this year, we're not going to get another one again. No, you can see how that's it can rally, just like we had in 2004. There's 2005 and 2006. There was some volatility in 2006, but still finished higher emerging markets compared to the S&P. That's the kind of move expected right now coming into 2018. Continued relative strength in emerging markets, and you can see a similar pattern on EFA, a little bit more pronounced to the downside, and you can see less of a outperformance move to the upside, and you did get a little bit of a golden cross or death cross there at the end of this year. So more weakness in developed markets, but there's going to be opportunity with this potential inverted head and shoulders pattern developing. Look for international stocks to continue to outpace heading into 2018. Even though U.S. economy is looking great, that strength in investor sentiment will start to look for value and opportunity for returns in other areas because of how highly valued the S&P 500 is. Doesn't mean we won't get, like I said, 2 to 3% expected average return over the next 10 years. Doesn't mean that every single year will be a 2% return. In fact, next year according to what we've seen, we can expect potentially another double-digit return, but with more volatility. In fact, almost double the volatility next year as what we saw this year. But with all of that, we can say, okay, well, even though that's what we're expecting in the S&P, there's still going to be opportunity. There's still years of pent-up opportunity of outperformance in these international areas that have been so beaten up compared to the S&P 500 really since 2010. So with the bounce in yields, you also see a bounce in real estate. What you don't see a bounce in is utilities. So no, excuse me, the bounce in treasuries. You see a bounce in real estate this week, not a bounce in utilities. So utilities are still struggling. Energy stocks are still doing well, even though they're, this week has been kind of quiet for them. It's been kind of quiet for everybody, right? But again, now as we head into the new year again, so what are the expectations from a sector rotation standpoint? If weakness in it, you can see this year has been, healthcare has been a big mover, technology has been a big mover. You can see the safe haven areas, double-digit gains, and all of those, not accounting for the dividend payments there. And then, of course, energy lagging. But remember how crude oil started to rally from mid-June on. The energy sector started to rally from mid-August on. So it's up 19%. It's really been struggling. Whereas you can see all these safe haven areas, utilities are actually down since that mid-August point. Healthcare up 7%, but those are all your safe haven areas are lagging behind. So what do we expect now then going into, and if I were to kind of zoom out for a few years here, let's go, we'll go out for a few years. You can see it's been a healthcare, consumer discretionary, technology area. They've been really pushing the S&P 500, is up over 100%. They've been pushing a lot of those gains higher. And you can see, like emerging markets, even though we've had a good few months in energy stocks, energy has been lagging behind the S&P 500 for years. So there's a lot of, again, like I mentioned before, there's a lot of pent up. In fact, really, if you take a look from mid-2014, when the dollar took off and crude oil tanked, from mid-2014 till now, the market itself is up almost 50%. Technology doing a lot of those returns, and discretionary as well. So a lot of those big tech names, that will still, rally and continue to move higher. But look at the return on energy stocks, down 20%. Material stocks, this is a lot of this dollars had a strong move. Material stocks are also lagging behind the market. So there's your opportunity in 2018. Industrials kind of matching the market there, lagging behind initially along with these. Financials also showing some relative strength. Expect weakness out of that unless yields continue to strongly move higher. I wouldn't be surprised if we get some relative weakness in financials heading into 18, but outperformance in industrials and materials and in energy stocks. There's a lot of opportunity there, a lot of value. And while there still could be some good returns in technology and discretionary, because they're still, on bullish trends themselves. If you take a look at the long-term view for technology here, that's a strong bullish trend. If you take a look at, again, another one, consumer discretionary, again, on the long-term view here, with a lot of their golden crosses occurring in early part of 2016, it's had a good run. So it's, you can't say, that they're going to automatically now start to come down. There's going to be some, you can even see last time the MACD was this high at the end of 2013. 2014, we've been looking at this time frame before. 2014, it still rallied. There was some more volatility, but still rallied. So there's going to be opportunity for gains in those areas, but you'll get some potential for outperformance. So for example, if I were to take a look at XLK relative to XLE, let's do it the other way around. XLE compared to XLK. So XLE used to be the biggest sector in the S&P 500 until this big drop. And then XLK has now taken over, the biggest component of the S&P 500 from a market cap standpoint since that 2014 drop. So look at that move, and really it started in mid-2008. That's when crude oil peaked really peaked in 2008 there. So you can see how we've really been lagging behind, but we've getting some higher lows with lower lows. So there's going to be some opportunity here for some outperformance in this area. And you can do the same thing for XLB compared to XLY. Kind of another one of those areas. XLB is already starting to outperform after years since that peak in 2008, and especially since its peak in 2014 of underperformance relative. So that's your area of rotation heading into the new year. So for our trade example today, I want to take a look at Netflix coming into its earnings here next month, and you can see a nice good day today. In fact, its market sentiment line is lower than it's been since dropping below this level here in January of 2016. So I'm not a big fan of comparing like levels to here, because here it was rising, market sentiment was rising. Here it was falling like it's doing right now. So this is the last time, in fact, let's kind of zoom out even further here. This was the last time we were falling at this level, and even then it's really this level here is the better comparison of where we were at. And it kind of looks like we are right now. Market sentiment's down. But you can see the intermediate line has jumped up. Near-term lines formed this bullish low point between, in fact, a couple bullish low points here after that long lower shadow, breaking up above previous highs, past couple of weeks highs, closing above those past couple of weeks highs. Good, strong 3.5% move today on decent volume as well. If I were to take a look at the volume here, you can see more than 1.5 times average volume, and obviously in a week when there's not a lot of volume in the market as a whole. So 3 green arrows. You can see where the MACD is crossing above 0 itself. The intermediate line crossing above 50. Market sentiment lines at a point where there's opportunity for some gains and some outperformance for Netflix going forward. Now it's had some weakness. It's been struggling versus Disney, a potential competitor now with Disney getting into the streaming world, but a semi-breakout move today. So now if I take a look at its options chain, we say, okay, well, I don't want to buy the stock because for like 2018, because again, it's been a good bullish stock. There's opportunity, of course, and we can buy the stock. It just takes a lot of capital, and it's not in one of those sectors, energy, materials, industrial. So I want opportunity. I want to take advantage of the technical signal today, 3 green arrow spike in volume, and the potential for some return with the other technical patterns we just discussed. And so we can do that by buying a call option. And now if I go out to this April, so I want to go out to far enough to where I don't have to worry about time decay. If you notice here, what I've done is I put up the Theo price, and I put it out, between now and at current volatility levels, the 1 standard deviation move is all the way up to 230. So if we said, okay, let's say it does get up to 230 between now and April. So that's what the Theo price is. So it's that April expiration, 230. You can see if I bought the 230, I wouldn't make any money. I'd spend 375 and lose it all because it wouldn't have any intrinsic value. If I bought the 225, I'd pay 455. It'd be worth $5. So I'd only make 45 cents. I'd make a 10% return. But that return starts to get bigger as I go further up. And right here happens to be the sweet spot here, right about at the money, close to being at the money. Well, it's relatively at the money, the 47 delta. You can see that the strike price, the ask price 12.15 compared to a $30 Theo price, because that's how much intrinsic value it would have. That gives me about a 247% return roughly, or 147% return, excuse me. That ends up being the best potential return, everything else being equal. And so we say, okay, the nice thing about that is we have earnings coming up, right? Earnings coming up next month. That could really, we have support here at that long lower shadow, but we could break that long lower shadow. So the nice thing about that, about having, and there's your potential reward, of course. If we get up to 230 anytime before, we won't lose that time decay, getting us down to the green line anytime before that April expiration. But the nice thing about this potential reward here, which is pretty favorable, I mean, obviously better than 2-to-1 reward to risk ratio if you were going to put a 50% stop order. And because of that, we don't have to put a 50% stop order. We can go further than that because we're going for a potential $18 return roughly. So that means we can theoretically risk 9 out of that $12, which is a good thing because that earnings is coming up. And that earnings could, we could drop down here, and you can see the max loss is $12.15. And if we drop down there today, it'd be $700 loss. But we'd be willing to lose $900 and still get a 2-to-1 reward to risk ratio if it hits that target. So, and knowing that if earnings come down, we've obviously got some support here at 180. If we were to break that in one fell swoop, then that's your exit, right? We know. We're breaking above Bollinger Bands here. We're breaking above, green arrows. We got 3 green arrows, MACD. Now, all these technical patterns say to buy now. And if that's all reversed on that earnings, then we don't have to wait to take the other $500 loss or whatever the case is. And I don't have to worry about taking a full a big loss because the reward potential allows the ability to risk up to, in this case, $900 out of that $1,200 reward. So it's a little different way to trade long calls that I've shown you before because it's kind of like we're buying stock. It's a longer term view of this. I want it to be able to, we got this breakout move that could lead to a trend. So I want to buy time that can allow it to trend and potentially get all the way to expiration. So that's why I put the Theo price at expiration. But I want to make sure that I buy something that's not too expensive. $12 versus $192 is a lot cheaper, but still offers me the best potential reward if I were to hold it all the way to expiration and lose all that time. See, that $12 is all going to be gone. So this $30 will be intrinsic value. This $12 is all extrinsic value. It's all time value. I'm going to lose that $12 between now and expiration. So this $30 will actually be on top of that. So that's why I say if you get out, if we hit 230 before, then you'll get that $30 the same, but you'll still have some of that $12 left before it expires. So to summarize, again, today's video was a kind of a preview of my outlook heading into a new year. So not just my outlook now, heading into tomorrow and next week, but the full 2018 calendar year. So a little bit longer video than normal, but the market's been really quiet, so there's not a whole lot to talk about this week. But I wanted to give you an idea in today's video of where money could be moving and how you could potentially transition your portfolios to take advantage of potential reward, knowing that anything can happen, and if anything does happen, we'll be doing these videos day in and day out to help you prepare, to watch for it, prepare for it, and know how to handle it if anything does, but also know how to handle your portfolio if we just continue to move higher and grind for at least another year. So with that, thank you very much for watching tonight. Keep coming back in 2018. Remember, we're taking tomorrow off, so Happy New Year. Have a great weekend, everybody. We'll see you back on Tuesday when market reopens January the 2nd. I believe that's January the 2nd. So we'll be back on the 2nd. Have a great New Year celebration. Enjoy your time. Remember to be safe as always, especially on New Year's Eve. We'll be back at it again in 2018. Now, lots of great, exciting things coming from myself and from Brandon, from Market Scholars in 2018. So stay tuned, and we'll see you all on Tuesday.